Well, it's a little after 11, so why don't I go over the quick housekeeping for people. Just I wanted to let everybody know that originally it would be later today, but given the volumes of WebExes and such, it would probably be tomorrow that we'll be able to send out a recorded version of this WebEx along with the slides you're going to see, and also some of the recent articles that we've had that you'll hear cited in some of the remarks. So I want to make sure everybody knows we'll be able to get all that out to everybody afterwards. And also the big part too is if you for questions, we've reserved a lot of time at the end for questions, and we know in some of the other WebExes that's been some of the most productive times because obviously those are the things on your minds as attendees. So we want to make sure we're answering those questions. So you'll see the chat box, you'll see it in this where it gives you that little bubble at the bottom if you hover over your screen using that chat box and then go into the drop down where it says all panelists. And then just type in your question, and we'll get to all those questions hopefully at the end. And so please, that's been really valuable. So if it's a question on your mind, it's probably on other people's minds as well. So we'll get moving, and I'll turn it over to you, Tom, to get things kicked off.
Welcome everybody. Welcome to our webinar. I'm Tom Bonadio. I'm the founder of the Bonadio Group, and we're going to talk a little bit about retirement plans. Obviously, with all of these crazy things that have been going on the last few months. Turns out that there's a number of regulatory changes, either from the Secure Act or the CARES Act, related to employee benefit plans. But today we're going to get a chance to feature some of our experts. We have obviously thousands of retirement plans in our client base, and we audit approximately 500 of them. So one of our experts in retirement plans, Todd Claiborne, is going to talk about some of the regulatory issues. And then we're going to get a chance to talk a little bit about our partnership with High Probability, and they're going to talk to you more about the investment side of the retirement programs. So it's a lot of good information. We'll try to go through it and get it done in this hour, but I think it's really good stuff for you guys to listen to. So with that, I'm going to introduce my partner, Todd, and Todd's going to talk to you about employee benefit plans and regulatory issues.
Great. Good morning, everyone. Glad that all of you can join us today. And like Tom mentioned, I'd like to cover for the next probably 15, 20 minutes, a couple of the big changes to the retirement plan arena during this past year. Today, I'm going to cover the Secure Act and the CARES Act. And sandwiched in between those, I want to talk about some common errors that we have found as experts in this arena and within our employee benefit plan audit practice, these errors that we found pretty consistently throughout a lot of our plans that we audit. So you want to go to the next slide, Steve? So I want to start off with the Secure Act. The Secure Act was signed into law at the end of 2019 and really was the most comprehensive retirement reform package for a while, since 2006. And it's pretty much the reason why the government and policymakers put this in place was that, they were just concerned with the nation's retirement savings account. There's a stat out there that the median 401k balance for those 65 and older is only around $60,000. In addition, only 55% of the adult population participate in workplace retirement plans. So those numbers are really scary when you think about the retirement of the American individual. So the government and the policymakers put this into place, and this act is more of a hodgepodge of a whole bunch of a little retirement policy initiatives. There's a lot in here that is included in this act. I could take almost half the day to go over it, but there's a few things that I wanted to cover for those related to retirement plans itself. So if you want to go to the next slide, Steve. So some of the most important things within the Secure Act I've listed here, and I'm going to cover only at a high level these plan document and communication changes that I have here. There's slides in the back of the appendix when you do get these slides that have a little bit more information, but I really wanted to dive into those affected those informations within the Secure Act that are really for the small employer that may or may not have an employer plan sponsored plan currently. But quickly going over what has changed for those that do currently have plans. The required minimum distribution date has changed. It was currently at 70.5, is now at 72. In the future, part-time employees are now going to be required, plan sponsors are going to now be required to offer participation to long-term, part-term employees. So this is a big change for those current plan sponsors right now. They still must meet some minimum age requirements, and they must complete 500 hours of service for 3 consecutive years. So they won't be included in plans for quite a while. You don't start counting ages for these, or you don't start counting hours for these individuals until the year 2021. So there's still some time for plan sponsors to kind of plan for that. In addition, there's been some penalty-free distributions for birth and adoption expenses that are included in this act. Now, this needs to be adopted by the plan. So some of these changes, you need to talk to your plan administrator, your third-party administrator, to see if you want to include these in your plan or not. Also within there, there's some lifetime income annuities options out there for plans. Right now, fewer than 10% of 401k are currently provided annuity option. The Secure Act now lessens the liability of plan fiduciaries when selecting an option to provide annuities as an investment option in plans as well. And lastly, Safe Harbor increases the max limit for any of those qualified automatic contribution arrangements. So if, as you're in, a lot of plans have the ability to have automatic increases, and that used to be maxed at 10% of compensation. This Secure Act has now lifted that to 15% of compensation. So I want to go over those real quick. I wanted to now focus on some other aspects of the Secure Act as it relates to the smaller plans. So if you want to go to the next slide, Steve. So there's been expansion of the multiple employer plan option. So for any unrelated small employees, they now are able to band together in what they call these open 401k options, or this multiple employer plans. Currently, these options were only allowed for what they call closed MEPs, which you had to be a participating employer that shared a common interest or a common organization structure. This new portion of the Secure Act now gives the ability for these smaller business owners to set up retirement plans for their employees. What's the benefits of these? Well, it's going to reduce the cost and the administrative duties that each employer would otherwise bear if they set up a plan alone. Like I mentioned, it doesn't have to be in the same industry. There's just be one reporting requirement under the 5500, and you would designate a pooled plan provider that would, act as the administrator of this plan. The one thing it does, one good thing that is included in here is it eliminates that one bad apple rule. So if you could think about it, if you have all these small employers coming into one plan and one of them screw up somehow, prior to this, the whole plan was at fault. They put in in this one bad apple rule. Now, if an individual employer, messes up their testing or errors in some way in the plan, it is now none of the other related participants or employers within this new MEP system will be liable for that. And these plans are effective for years ending December 31st, 2020. So the next, Steve. Now, here's another thing for these small employers that may not have a plan currently set up right now. And there's plenty of business tax credits that are out there that encourages employers to become plan sponsors. Prior to this, the tax credit was only capped at a $500 max. Now, this increases the tax credit for business startup costs up to $5,000. So it pretty much, the credit will cover 50% of eligible expenses to set up or establish the administration of the plan. And it's, that $5,000 max is based on based on the number of non-highly compensated employees are included in the plan. In addition, there's another credit out there as well for if you have an automatic enrollment feature within the plan. With that, it will provide you another $500 credit for the next 3 years. So these credits hopefully will encourage those small employers that don't have plans set up currently to set those up in the near future. Next slide, Steve. So within this act as well, there was some increase in the penalties of certain filings for this. So previous to this, I always thought these filings were pretty high. They made it even higher. It used to be a failing to timely file a 5500 was a $25 per day penalty up to $15,000. Now they've increased this tenfold. So it's now $250 per day, not to exceed $150,000. So this is some big time money that you were talking about. So there's some, so I guess the moral to this story is you got to have the right players around you to help you figure out these plans. You got to have a good advisor on the plan side with your third-party administrator to make sure they're doing everything. You have to know your fiduciary responsibilities as a plan sponsor to do the right thing. And you have to have your other advisors around you, your accounts, your legal counsel, to make sure you're doing everything you need to do. Because these penalties you don't want to run into. So that's a good segue, if you want to go to the next slide, Steve, into some of these, what common errors we have found in employee benefit plans. And I listed 5 of them here that I have seen pretty consistently within my practice in this area. And if you want to go to the next slide, Steve, we can go over these. First thing is understanding plan provisions. So here, I think the biggest thing is to understand your plan document. And within there, it's going to define what plan compensation is. And there's been plenty of times I've talked to a number of my clients and they have a certain understanding of what plan compensation is. And then I read the plan document and it's totally not the same thing that I just talked to them about. So make sure you do understand what is going on in your plan documents within plan compensation. If it just says W-2 wages is covered, remember, W-2 wages can cover certain things, not just wages, but it can cover group term life insurance or bonuses, overtime, commissions. Are all those are all the deferrals being calculated appropriately based on your definition of compensation? In addition, eligibility, enrollment, who is eligible, who is not, what are the dates of eligibility, what are the dates of the eligibility requirements? There's usually a minimum age requirement, in addition to a length of service requirement. Who's monitoring that? How often is there a defined entry date for these participants to get into? There's been some that I've run into where the entry date is blank, so they're eligible as soon as they hit those certain marks. But there's a lot of times we don't see them being participants in the plan until much later, and the employer and the plan sponsor is eligible. It's their responsibility to let these employees know when they are eligible to participate. So if you want to go to the next slide. So another thing is timely deposits of the employee deferrals. Now this was a big area years ago. It's gotten a lot better now. But with this day and time of cash being crunched right now, there is currently no relief out there now with this. If a participant is deferring their compensation to be put into these plans, you as the fiduciary and the plan sponsor have a responsibility to remit those very timely. There's no lag in this. Like I said, there's no relief in this. So what's the general rule? Well, I've quoted the rule here per the DOL regulations. It says the earliest date the employer can reasonably segregate these amounts, but in no event later than the 15th day of the month of the following month. Now that is what they call the safe harbor, and it's mostly for those that are not considered large plans. Those are considered large plans. There is no safe harbor, and the informal guidance on that is anywhere between 3 to 5 business days to remit these. However, if you've established a pattern, if you've been able to show that you can remit your payroll taxes within a few days, the DOL will come in and be like, if you could do that, why can't you remit your deferrals in that same amount of time as well? So if you've established any sort of pattern with this, or shown that you could do this at a certain amount of time, that's probably where you want to stick to. Next slide, Steve. So employer matching and profit sharing, here's another common error. Eligibility issues as well. It could be based on, you may have different eligibility from participating in the plan with employee deferrals than you do with employer matching and profit sharing as well. So again, I think it becomes more of a monitoring of how you monitor your participant base to see if they are truly eligible. And then there's some calculation issues as well. There could be, if your plan has different wages or if compensation is defined differently between deferrals, employer match, or profit sharing. Again, do you have a good process and procedure in place to help you with that calculation? And then again, you may be in the need of a true up. For example, if the match is not calculated until post year end, is there a proper true up that is being done according to plan document? And lastly, are forfeitures being applied and according to the plan document? Can forfeitures even be used to help pay down the employer match or the profit sharing? Again, it all goes back to your plan document and understanding what it defines in there. Next slide, Steve. And the last thing is the ADP and ACP testing. That's the actual deferral percentage testing and the actual contribution percentage testing. These are required to be done for some traditional 401k plans. Again, these are for the most part should be done by your plan administrator. And especially if a competent plan administrator is out there, they should be all over this and making sure there's no surprises at the end of the year. But there's been times that this has been missed by plan sponsors, and it could be very costly for them as well. Now, if you get a safe harbor plan, you could avoid a majority of this testing, but there is still testing needed for some of the safe harbor plans. So that is what I wanted to cover on the employee or the plan sponsor error side of things, common errors out there. And I wanted to get into these CARES Acts. As you know, this has been a pretty significant act that went into place. A lot of it had to do with the PPP loan and other tax advantages, but there was a few things I wanted to highlight that relate to and will have effect on your plans. So if you want to go into the next slide. Again, I just wanted to highlight a few of these. There's going to in the appendix there will be some more information about these, but within the plan document and there's the changes in the plan document. There's going to be what they call a new distribution option out there for coronavirus-related distribution. This gives participants within your plan the option to take up to $100,000 for a, again, penalty-free distribution if they are ineligible, if they fall under the eligibility of this plan or of this distribution. This would need to, if you want to put this into your plan, this needs to be adopted. So make sure you talk to your plan administrator to get the proper paperwork to be done with this. In addition, there's been changes to some of the plan loans as well. It has increased the amount that can be taken. Previously, it used to be $50,000 up to 50% vested. They've increased that now to $100,000 to 100% of the amount vested for these plans. And in addition, there's an option for participants to delay their repayments as well on any plan loans. Again, this will need to be adopted as well, so please talk to your plan administrator if it's something you're looking into. Last thing was the required minimum go back if you want to go back to required minimum distributions. There's a waiver of the RMDs so you don't have to take any RMDs, required minimum distributions, for the year 2020 within defined contribution plans. It's not effective for defined benefit plans. So again, there'll be there's more slides in there with more information about these in the appendix. And one thing I did want to cover, if you want to go to the next slide, Steve, is the delay of the pension contribution. So the minimum required contribution for any single employer pension plan, including your quarterly contributions that would be otherwise due in 2020, has now, they've extended the due date to be now January 1st, 2021. So this gives relief for those companies that are just struggling with, in the short term for cash. However, the delay of this contribution, or the delay of these contributions, they're required to be increased by any interest accrual accrued between the due date and the date you actually pay. So just keep that in mind. So if you have any DB plans out there and are just short on cash, again, talk to your advisors, talk to your plan administrators, determine if delaying this makes sense for you. And that wraps up my portion. I do want to talk a little bit about our Bonadio Cares team and our consulting team. We've had a team of individuals within our firm who are working daily with clients and keeping up with the ever-changing laws that is going through and FAQs that are coming through when it relates to this CARES Act. So we do have a lot. We have a lot to offer outside of just the retirement plan option of this, if anyone is interested in that. And that being said, Steve, I'll change it back to you.
Great. Hey, thanks, Todd. I know there's a ton of things to cover, and I appreciate it. I think people will appreciate, too, as you mentioned, when they get the slides, there's a lot in the appendix that will get even more detailed and a lot of great information. So thank you very much. So what we'll do is we'll now get into the economic and marketing side. And I know there's a lot of people on the call that we work with quite a bit, and there's others that we might be new to. So just to give a quick update of who we are, high probability advisors, we think we're kind of a unique firm in that two main things that stick out to us: experience. Our executive team is over 30 years average in the industry, and we all came from running multi-billion-dollar firms, investment firms. But we all also came together because we saw the evolution that was taking place in the investment world, and we wanted to be ahead of that curve. And I think that's where the innovative side really comes in. We're taking advantage of some of the newer tools that are out there to stay focused on, what has become our mission, academically proven strategies only, evidence-based strategies that allow us to keep things at a low cost and try to optimize that tax management to deliver the highest probability of success for our clients. That's where the name came from. So just to give you a little background on us and what we're about. But what we're going to do is, again, as everybody well knows, we're in this COVID outbreak and social distancing environment, and all the impacts that are taking place with that, the global, economy and the financial markets. So where do we go from here? So I'm going to turn it over to Jeff Coons, one of our partners, and in addition to having previously run a $50 billion investment management firm, Jeff's real passions as a PhD in economics are on the economics, market, and investing side. So without further ado, I'll turn it over to Jeff on that front.
Well, thanks, Steve, and good morning, everyone. As managers of businesses and nonprofit organizations, we're often asked to make decisions despite having less than perfect information. However, the COVID-19 pandemic and the social distancing being used to combat it have really created an extreme version of this. To make good decisions, we need to have a framework for bringing new information in and adapting our path accordingly. I'd like to offer over the next few minutes such a framework for looking at the economy and the markets. And then I'd like to turn to one area that we haven't had relief from in the pandemic, and that's your fiduciary responsibility for your retirement plan. So with that, let's talk about the economy. And let's think about this framework, starting with taking the information that we need to make good decisions and breaking it down into three buckets: what we know, what we don't know but others do, and then what is unknowable today. Now, if you're anything like me, you spend a lot of time over the last few weeks trying to cut down on the second bucket, things that I don't know that other people do. But what I've found when listening to the commentary and reading what the experts say about the economy, in particular the economic recovery, where we have a V, a W, or a Nike swoosh recovery, what I'm hearing is much more guesswork about the unknowable than truly new information. So what do we know? If we look to the next slide, we know this equation: C plus I plus G plus X. C is consumer spending, I is investment spending, G is government spending, and together with net exports, they represent the total economic activity of any nation. If there's anything you remember from your Economics 101 class, this should be it. It's the framework that I use whenever anybody's making a case about the direction of the economy. I break their argument down into these components to test their validity. So the first component, C, consumer spending, was about 70% of the US economy prior to the pandemic. And what we need to understand about consumer spending is that consumers spend incomes, and income requires jobs. So we need to hear an argument about the return of lost jobs in the economy to make any case about the direction of the recovery. I, investment spending, was about 17% of the US economy, and that's driven by CEO and CFO confidence. If executives believe that demand for their products will exceed their productive capacity, they'll invest to expand that capacity. So business sentiment surveys are very important to keep an eye on investment spending in the recovery. And this brings us to G, government spending. It also brings us to the second point of what we do know. We know that the federal government has worked aggressively to try to combat this downturn. That includes acts that have allowed for extending and expanding unemployment benefits, loans to employers, some of which are forgivable, and outright checks to consumers. Likewise, on the monetary policy side, the Federal Reserve has lowered interest rates, injected liquidity directly into the financial system, and backstopped mortgage-backed bonds, asset-backed securities, corporate bonds, and municipal bonds. Now, we do know that all these things, all this effort is not going to be enough to stem the recession over the near term. What we don't know, though, is whether they'll be effective over time. And that leads to what is unknowable today. We can't know the timing of this recovery because it's being driven by the path of a pandemic and by decisions that have not yet been made. I'm not just talking about the decisions of governors as to when to open their states. I'm also talking about individual consumers and businesses deciding when it's safe to come back into the economy and what precautions do they take to avoid a resurgence of the pandemic. Likewise, we don't know and can't know the structural damage that will be done. How quickly can employers negotiate down their debt burden so they can begin to rehire and start investing again? Finally, we don't know consumer behaviors and how that will change. We don't know whether we're ever again going to be willing to stand in a crowded line for a crowded restaurant seat, or to stand in a crowded line for a seat in a stadium, or a Black Friday sale for that matter. So we just simply don't know the answer to these things. And rather than trying to build our decisions around a VW or Nike swoosh recovery, which is based on guesses of things that are unknowable today, it's important to make decisions based on what we do know today and make sure they're flexible enough to adjust to new information as it comes in. And please understand that new information is not going to go all in one straight direction. A lot of times recoveries are 2 steps forward, 1 step back. But if we stay focused on the trend, stay flexible, and use this framework to evaluate what's going on with the economy, it can help us make better decisions. So let's talk about the markets. If we turn to the next slide, there's a table here that shows different stock and bond market indexes. And the first column of numbers shows the returns of those indexes from the peak of the US stock market in February to its trough that we've seen to date, March 23rd. And then the last column of numbers show the numbers that you're likely to see in the performance reports that you're getting through the end of April. There are 2 points that I'd like to make about the markets. The first one is that the differences in performance among different funds or different managers, different portfolios, will be driven far more by the basic styles and investment strategies of those managers than any amount of skill. And unfortunately, no matter how clever your advisor's monitoring system is, it's going to make certain managers look very bad and other managers look good, and it's going to make it very difficult to have prudent decisions coming off of this time period. To highlight that, let's look at the 4th row here, the Russell 1000 Growth Index, and look at the last number, -1%. U.S. large cap growth stocks are barely down year to date. And actually, if we updated this through yesterday, the large cap growth stocks are positive year to date. But if you look at the number right above that, large cap value stocks were down, still down 18% at the end of April. And the line above that, small cap stocks were down 24%. What this means is that any managers you have that their process results in a full boat of the big cap tech names, they're going to look brilliant and they're going to look very low risk. Whereas your managers that have a valuation discipline or are willing to own smaller companies are not going to look very good in any monitoring system. However, a recent paper that our Chief Investment Officer, Mike Jones, put out called The Elephants in the Room does a great job of highlighting that the large cap growth stocks are anything but risk-free, and we need to be very careful about making decisions based on these numbers. The next point I want to make is that we also need to be careful about using the word unprecedented. To highlight this, I want to start by a story that Mike Jones shared with our investment team back in March. He relayed a conversation that he had with his mother back after September 11th, 2001, and the tragic events that happened then. He was talking to her on the phone, and she said, this is the worst thing that's ever happened in my lifetime. And he correctly pointed out that, Mom, you were alive and a young lady at the time of Pearl Harbor and World War II. By a magnitude, that was a far worse event than what we just saw, as tragic as it was. She said, I know, this just feels worse. And what behavioral finance theorists call this is recency. Things that happen more recently have a greater weight to us than things that happened in the past because we know how that turned out. We need to be careful about that burden of recency. And I know this is a very challenging environment for you, your business, for your organization, and it's a very unique time, but the reality is every bear market is unique. And if you turn to the next slide, what you'll see is that we have had bear markets as swift and certainly far more severe than the bear markets that we've seen so far in this period. Yet, that history of swift and severe bear markets is part of that long-term return history that we use to explain why participants need to stay focused on the long term and stay invested in equities over time. So staying invested for the long term, despite bear markets being something that are just a reality for us as long-term investors, is a very important message for the retirement plan. And this brings us to our last point, which is the retirement plan. So if we go to the next slide, one before that. So, there have been a lot of areas of relief that have occurred in the pandemic. One area that we have not heard is nobody has given relief to plan sponsors for their fiduciary responsibility for their plans. We have seen, as Todd mentioned, relief for plan participants to be able to take out money out of their plan under certain circumstances, penalty-free, if they truly need those balances, and to take out more in loans. But, there is a cost to that, and the next slide illustrates that. So this is a model that we put together to illustrate the impact of missing just a few years of contributions in your retirement plan. If a participant does everything they should be doing, they're saving 10% per year in retirement, they're investing for the long term and getting good returns over time, their retirement income may last to age 100. Yet if they miss just 1 year of contributions at age 55, that could result in 2 years of lost income in retirement. If they fail to make that contribution at age 25, that could be double that in terms of the impact on their retirement long term. And if they miss 2020 and 2021, the impact of that could be even double from there. So participants need to understand that there are real implications for getting off track of their long-term plan in terms of their ability to fund their retirement. You as a plan sponsor, you don't have a lot of control over what the participants do. But there are things that you can control that will have an even bigger impact on a participant's ability to retire on time and with dignity. And if we go to the next slide, one of the most important ones is making sure that your plan has competitive fees in light of the services being provided by your providers and your advisor. So once again, we have that same illustration of do everything right, you may be able to live to 100 with your retirement income. But if you have 50 basis points higher in expenses than what is competitive, so you're paying 0.5% more in expenses, and that's coming out in the returns of your participants, that could cost as much as 12 years of retirement income for your participants. If you're paying 1% higher in fees than what's competitive, that could be 17 years in terms of impact. And fee due diligence is one of these things that we just simply can't shed in terms of fiduciary responsibility as a plan sponsor. In fact, I'll go a step farther. In difficult return environments like we've had, there's a lot of looking backwards in time, seeing did the plan sponsor do everything they could do to help out. So fee due diligence is very important. It's an action that is worth taking today. I know that there's a big burden on all of us in this environment. There are a lot of things that seem more important to focus on today than the retirement plan, but taking the steps to do a review is worthwhile for participants and their ability to retire over the long term. The next slide, though, is the last point I want to make, which is your advisors, your providers should be able to help you through this burden. That administrative burden, that fiduciary burden can be shared with good providers. And let me start with your retirement plan advisor. Retirement plan advisors can step up and take 338 discretionary responsibility for the investment decisions of the plan. What that means is that you still, as in all cases, are responsible for monitoring that your advisor is doing what they should be doing, but they're going to take responsibility for all the other decisions, including that difficult decision of whether or not to make a change to the investment menu and how to do that. Those things are all being borne by a 338 discretionary advisor. On the other hand, a lot of advisors will step up and take 321 fiduciary responsibility, which means they'll take responsibility for their recommendations, but ultimately you're still on the hook as a plan sponsor to make the final decision. And then finally, there are a lot of advisors out there that do not take fiduciary responsibility in writing, which means that whole burden is on you. So there are ways of working with advisors to share that burden, so you have to spend less time staring at performance numbers so far year to date and trying to decide whether you should be making a decision about the funds. Those things can be borne by others. Likewise, a good, strong record keeper will have online tools that will help participants make good long-term plans and make the trade-off that they need to make between a short-term decision versus staying on target for their long-term plan. And then finally, your auditor, if they're deep and they understand and have done a lot of different plan audits, they will have seen a lot of things, and they'll be able to help identify problems before they become expensive to fix. So your advisors can help you. A good record keeper, a good administrator, third-party administrator, good auditors, good advisors should be able to share that burden to allow you to focus on the other things you need to in this environment. And with that, I'm going to turn it over to Steve to wrap up.
Thanks, Jeff. Thanks for how you went over that. Between what Todd had to say and Jeff, I think hopefully we covered a lot of good information for you, and just give you a sense of how we think we can help. But what we're doing, and as Jeff mentioned, what we're doing a lot of right now are the fee due diligence. We've had a lot of people ask us, that sounds important. I really need to do that. So we can run through that, make sure that the costs line up, and then you've got a document that you have in your file that says we've looked at this. And so if you ever get an audit, you have that in your file. Similarly, we do that even more expansively for retirement plan health review. Just again, not just the plan fees, but also the share classes, which, as many know, that's a very important. You could have a fund that's performing well, but you're in the most expensive share class, and that's where that cost is coming from. That's blowing up your, the cost structure for your participants. But that menu design, the fund selection, and the investment policy statement review, we've done presentations just on that, and we've gotten a lot of people saying, help us go through that as well. And it kind of ties back to one of the things Todd said as well, making sure you're doing what your plan says. A lot of these things were put in place. People started their plans maybe 15 years ago, and it's grown a lot, but they've never gone back and revisited that, and making sure that they're following their investment policy statement, or that the investment policy statement still makes sense for them now. The main thing, those are the things we offer more on one-time basis or periodic. What we are focused on is being a full fiduciary 338 advisor and providing those solutions and quarterbacking and bringing all those advisors that, like the third-party administrator, record keeper, all those things, and pulling it together. And it really fits our mission to do it at that 338, that full advisor, full fiduciary protection for the plan sponsors and such, as much as possible. And that's what we want to do. We go right to that, and then try to stay focused on making sure the costs are low enough so that we put together a really competitive offering for you and you for your participants. So those are the things, the ways we can help. If there's interest, let us know. We'd be happy to work with you. On the Bonadio Group side, as Tom mentioned, with the affiliation we have with the Bonadio Group, it's been a fantastic affiliation for us, and working with people like Tom and Todd and their teams, because they have a full business advisory, tax consulting, so all those aspects come into it. So it's a lot of breadth. And also, as Tom mentioned, they're one of the largest retirement plan auditors in the country. So they have that specialty, and it's nice for when we were come across questions we haven't seen before. We've got a great team that we can go to. So that really summarized a lot of ways we can help. I know Todd mentioned the CARES team at Bonadio that is willing, ready, and able to help in any way, shape, or form. So with that, we'll move it over to questions, and I'll take a question first that I know we've gotten previously. It came up when we were making the presentations. Is why are there check marks under high probabilities bullets, and why are there ampersands under the Bonadio ones? Well, a check mark is in our logo because we're trying to check all the boxes for our clients, trying to make sure we cover all those bases. And for Bonadio, Tom is big about and more. They're not just accountants; they're accountants and more. So that ampersand is big within their world. So we thought that would be helpful, but I didn't want to confuse anybody with those bullet points. So with that, we'll turn it over to questions. And we already have one that's come in, and Todd, it's really directed to you. And it's kind of two-part. Can an employer get the tax credits for plan conversion from a simple or a SEP or a simple to a 401k? And also, if they join a MEP that you mentioned, are they eligible for the tax credits as well? So I'll throw that to you.
Yeah, so I guess regarding the tax credit, the credit is out there for any new plan sponsors or new employers getting into a plan, or if they've been set up a plan within the last 3 years. So that's where the tax credits come. And then as for this MEP, if they're going to join a MEP and any costs associated with them, as of right now, it looks like they would be eligible for these tax credits. But as we all know, this law is changing on a daily basis. So there may be more regulation coming out on that. But as of right now, it seems like you'd be able to take that credit.
Great. We got another question for you, Todd. Is the deadline for filing the Form 5500 still the same?
As of right now, yes. That has not changed as well. It's still going to be for a calendar year. It will be as of July 31st. A calendar year plan with the extension, it will be October 15th. So that has not changed currently.
Gotcha. Okay. We've got another question, Jeff. This is more focused for you, I think. How frequently, you mentioned these fee due diligence, how frequently should a plan do the due diligence on the fee competitiveness?
So, things do change with the plan. Plans can grow sometimes very quickly, and, big major changes, we should certainly use that as a triggering point to take a look and see, if we're competitive. But I would say every, 2 to 3 years, it's not bad to have a regular habit of that. And frankly, in our full 338 fiduciary services, we make it part of an annual review that we do. So we will automatically, as part of what we do as an advisor, include an annual review of the fees just to make sure that, we're not missing anything. But, really every 2 to 3 years, it probably makes sense to make sure that, with all the things changing, with the competitiveness of fees in the industry, that, what you're doing is competitive relative to the services you're getting.
Great. Okay. And sort of a follow-up question, I guess, was how do you know if your advisor has full fiduciary responsibility?
Right. And so, an important aspect of fiduciary responsibility is accepting it in writing. And, you should have a document that is signed by your advisor that explains the responsibilities that they're willing to assume. Likewise, your investment policy statement will often outline who's responsible for what. But, if you don't have a signed document saying what they're responsible for, they may still have some responsibilities, from a regulatory standpoint as to what they are doing. But in the end, that full protection comes from, having it signed off. And so for a 338, then they literally need to have a document that says we've signed on as a 338 discretionary advisor, and we're taking full discretionary responsibility for these things and outline exactly what they are.
Great. Okay. I'm encouraging people on the call to send in your questions. We've got 2 more lined up, but please, we're able to take more. Next one, Todd, I think this is more for you. If a plan determines that they had late remittance or other plan errors that need to be addressed, how do they go about fixing them?
Yeah, so I think the first thing you would want to do as a plan sponsor would be to contact either your plan administrator to talk about it and shed some light on the situation. And depending on how major the error would be, you may need to get some legal counsel involved as well. But there is some good guidance out there. If you go to the IRS website, there's what they call a fix-it guide, which covers some common mistakes and resolution of the common errors out there for plan sponsors. And there's certain ways you can correct it. There's self-correction programs, which are pretty simplistic that can be done. However, depending on how drastic the error is, there's a voluntary correction program out there as well that may be needed. And that would cost, I think there's a filing fee to do that as well. You let the IRS and the DOL know of the correction, and then you pretty much have to wait to get response from them to see if they correct it or not.
Gotcha. Okay. Thank you, Todd. Jeff, there's one more that I think is up your alley. If an advisor's reporting system says to replace a fund in our plan and we don't do it, then aren't we creating greater fiduciary risks for ourselves?
Right, and so this is very challenging because if you've adopted a very specific approach, and if it's baked into your investment policy statement, you do not have a lot of flexibility, even though in the end, as a fiduciary, judgment is an important part of being a fiduciary and making good decisions. Documenting exceptions is important. And I do think that there are environments like what we've seen that are worth documenting. Here's the reason why, as a fiduciary, we felt it was prudent, not to make a replacement or to give more time. Ultimately what you want to do is make sure that your monitoring criteria are flexible enough to accept the idea that not everything works perfectly, and funds don't always outperform quarter in and quarter out, over any past time period. In the end, having the advisor take responsibility for the decisions, does take some pressure off on that.
Gotcha. Again, I'll encourage any more questions. I've got one more of sort of a general investment question. It was given how awful the economic news has been, can you, how can the S&P only be, or now getting close back to only less than 10% down so far this year? How can the S&P have such a recovery, I guess is what they're saying.
Right. So, that initial reaction that we saw to the market was investors basically digesting the reality of the environment that we were in, which was a pandemic that was unchecked. A lot of aggressive steps were being taken, and the markets essentially digested that information and came to the conclusion that the cumulative impact of this over the long term, was, not as severe as initially thought with that downturn. Does that mean that we've seen the lows and it's never going to go down again? No, new information may come out, but markets are very good at digesting new information and adjusting from there. This is not just about how much you go down over the short term. This is the length of time that it takes for the fundamentals of businesses to recover and to move forward. And so it's less about how far down you go, and it's not even necessarily about how long it takes to recover. It's the combination of the two, and over how long, how badly our cash flow is damaged. And essentially what the markets are saying is there is some lasting impact, but it is not nearly as deep as they feared, when the pandemic was unchecked.
Interesting. Okay. That's all the questions I see so far. So maybe we'll just wind up here and let people get off to an early lunch or whatever they're going to do. But I just want to remind people that, again, we will have the recorded WebEx and these slides. And like we said, there's a lot more slides in the appendix, which could give you a lot more depth that complements Todd. And we'll also include some of the articles that we cited today as well. So thank you, everybody, for attending, and stay safe and healthy, and we'll hopefully talk to all of you soon. Thanks.